Hello, I'd like to talk to you today about the impact of the changes to entrepreneurs' relief that were made in the Finance Act 2019. Now, I have previously recorded a session looking at the new rules, and really what I want to do today is to develop those a little further by looking at a couple of worked case studies and take them beyond where we'd got to. But first, I probably just ought to remind you what went on in Finance Act 2019. There were two main changes. The first was the introduction of what is usually referred to as a new 5% economic test for disposals of shares. Now, as you'll recall, for many years, indeed ever since Entrepreneurs' Relief came in 2008, the rule has been that for the last 12 months, your client had to dispose of shares which carried at least 5% of the ordinary share capital of the company, having at least 5% of the voting rights. And as I say, that position had been unchanged from April 2008 until very recently. But at the budget, at the end of October last year, the Chancellor introduced two new additional 5% tests. So these were not alternative, these were in addition to the 5% ordinary share capital and voting rights requirements. And basically, in addition to those original two, they had to be entitled to 5% of the profits available for distribution, and you had to be entitled to at least 5% of the assets in the event of the company going into winding up mode. So in other words, there were now 4 5% tests: ordinary share capital, voting rights, distributable profits, and assets on a winding up. And one of the problems that people very quickly spotted with the 5% of distributable profits test was that this could have an adverse impact on many private companies which use what are often referred to as alphabet shares. In other words, different classes of shares, usually held perhaps by different members of the family, so as to facilitate a special method of dividing up profits by way of dividend. And although the government said, as I think I pointed out at my time of my last recording, that they had no intention of attacking these alphabet-type share arrangements, obviously, on second thoughts, HMRC decided that perhaps it would be sensible to not replace, but to offer an alternative to these two new 5% so-called economic tests. And as a result, about 2 months after the autumn budget, this was on the 21st of December 2018, just before Christmas, they announced that they were going to bring in an alternative economic test to these two new ones. And the point was that provided your client satisfied either the old 5% economic test or this latest one, you were in business. The latest one basically said, in the event of the company as a whole being sold, would your client be entitled to at least 5% of the sale proceeds? So even though the company as a whole wasn't necessarily being sold in its entirety, you pretended that it was, so you were using effectively the market value of the company for the whole company at the date of the so-called disposal, and you asked the question, is my client entitled to 5% or more of those sale proceeds? If the answer to that is yes, then the likelihood is Entrepreneurs' Relief would be available. And the fact that they might not have passed the original 5% distributable profits and net assets test didn't matter in those circumstances. So that was one set of new rules. The other set of new rules applied across the board to all disposals of business assets, not just the shares, and it said that with effect from the 6th of April 2019, so unlike the first set of changes, which took effect on the 29th of October 2018 onwards, largely the new rule for the holding of business assets only took effect from the 6th of April 2019. And basically, what this did, it doubled the required holding period from 12 months to 24 months. So the position nowadays is that you've got to have held your relevant business asset, whatever it may have been, for at least the last 24 months. And you have, of course, got to have satisfied all the key entrepreneurs' relief conditions throughout that time frame in order to attract the relief. So that's just a very brief summary of what the changes did. And what I wanted to do in this particular session is to have a look at a couple of case studies, worked examples, worked illustrations, showing the impact of these new rules with figured examples. So if you have a look at the notes which accompany this course, you'll see my first case study relates to a successful owner-managed business called Family Traders Limited. It's been operating since the early 1990s, and the company has got two classes of shares, A shares and B shares. Broadly, the two classes of shares rank equally for dividend and voting purposes, so of course they count as ordinary share capital, and as you can see, the company had a total of 180 A ordinary shares and 60 B ordinary shares. The A shares are split between two shareholders, Andrew and Ben. The B shareholders are owned entirely by Colin. And as you can see, given that we've got a total of 240 shares, Andrew with 100, Ben with 80, and Colin with 60 comfortably pass the old 5% test. Indeed, they all have 25% or more. So as long as they were directors or employees, there would be absolutely no problem in the past about attracting entrepreneurs' relief. But one of the conditions that was imposed when the share classes were created, probably because Andrew and Ben were what we might call the founder shareholders, was they introduced an element which said that in the event of the company being sold or being wound up, 97% of the capital rights would accrue to the A shareholders, that's to say Andrew and Ben, and the remaining 2.5% only to the B shareholders. As you can immediately see, when we turn to the latest rule changes in the Finance Act 2019, as far as Andrew and Ben are concerned, they don't have a problem. If they make a disposal today, they will pass the 5% ordinary share capital test, they will pass the 5% voting rights test, and they will pass the 5% sale proceeds test using the latest of the economic tests, the one that was introduced on the 21st of December 2018 in those circumstances. Unfortunately, Colin would not be in the same boat, because as far as he was concerned, he would not get, given that he was only entitled to 2.5% of the sale proceeds or liquidation value, then in those circumstances, he would not satisfy the first economic test introduced on the 29th of October 2018, because remember that said you had to have at least 5% of the rights attaching to the winding up as far as the value of the assets were concerned, and he's only got 2.5%. And similarly, on the sort of, if you could call it that, hypothetical sale of the whole company, looking at the latest of the economic test, he would still only get 2.5% of the sale proceeds. So what it means, of course, as far as Colin is concerned, is he is now denied entrepreneurs' relief. It would, of course, be possible to alter the Articles of Association and uplift Colin's voting rights in the light of these changes. But remember, of course, given that we've now got a 24-month waiting period before you attract entrepreneurs' relief, that would be a doubling of the length of time Colin would now have to wait before he could again qualify for entrepreneurs' relief. So, as I say, that first case study is intended really to show the impact of the main new rules in that particular context. My second case study involves a company called Hij Limited. This is again another privately owned company, and we will assume that some years ago the three shareholders who run the business, Harry, Ian and James, decided that their company needed some additional finance which their bankers were unable or unwilling to provide. So in order to get the money into the company which they felt they needed, they turned to private equity, and a private equity firm agreed that their project was satisfactory. They were prepared to put money into the business, which they did in the form of £2 million, for which they received 2 million A ordinary shares, as distinguished from the main ordinary shares which Harry, Ian and James, the three management shareholders, held. Now, again, if you have a look at the little table in the notes, you will see that given that both the A ordinary shares and the original main ordinary shares count as ordinary share capital, and we'll assume, as far as one is concerned, they would also attract probably votes as well, there would be no difficulty as far as the management shareholders are concerned qualifying for entrepreneurs' relief on a disposal, because even after the private equity firm put its money in, Harry still had 13.3%, Ian still had 12.5%, and James still had 7.5% of the company, as far as one is concerned. But what I wanted to look at was a particular point that relates to the latest economic test that now arises in this particular context, because one of the terms of the private equity injection of funds was that in the event of the company being sold or wound up, holders of the A ordinary shares were to be entitled to the first £3 million received on that sale or winding up, and only the balance would be split between the private equity firm and the three management shareholders, pro rata obviously in accordance with their shareholdings. And what I've assumed in this case study is that on the 1st of June 2019, so well after these new rule changes came in, the shareholders agreed to sell the entire share capital of Hij Limited for £50 million. Obviously, that means the private equity firm has its prior slice of £3 million, so we're only then dividing up the remaining £12 million, and obviously the three management shareholders, owning as they do 1/3 of the company, they would be entitled to 1/3 of 12 million, i.e. £4 million. The balance of 11 million being the original 3 plus the 2/3 of 12, 8 million, so making your 11 million, would of course go to the private equity firm, and we aren't concerned with their tax position. As far as the three management shareholders go, Harry, Ian and James, their 4 million would be split pro rata to their respective shareholdings, which, as you can see, gives them 1.6 million, 1.5 million and 900,000 respectively. When you look at those figures as a proportion of the total 15 million, you can see all three of them qualify for entrepreneurs' relief, because do remember that what the legislation says is that when you're looking at this hypothetical sale of the whole company on the date of the shareholders' actual disposal, you do so on the 1st of June 2019 and not on some earlier date. Now, as you can see, even James, who has the smallest shareholding, his entitlement of 900,000 vis-a-vis the 15 million that they got for their company, that represents 6%, and that, of course, comfortably passes the 5% test. But the point that I wanted to make as a sort of concluding angle was to illustrate that if that company had, say, only been worth, shall we call it 7 million and not 15 million, say 2 years earlier, so let's call that on the 1st of June 2017, the private equity firm would then have taken the first 3 million, as we've already explained. That would then leave 4 million to be divided up between the shareholders. And of course, as far as James is concerned, he would only be entitled to 7.5% of that, or £300,000. 300,000 as a percentage of the 7 million is 4.3. So can you see, James, on that basis, would not have had 5% throughout the 2 years up to the 1st of June 2019. That doesn't matter, because what it says, when you're looking to see whether he passes or fails this 5% latest economic test, is you look at the position on the date of the actual disposal and not some hypothetical earlier date. And of course, as you know, the basic premise of entrepreneur's belief is, of course, normally you've got to satisfy your 5% and your other entrepreneur's belief test throughout the qualifying period. If you like, this is a slight exception to that rule. So I hope those two case studies provide you with a sort of detailed number crunched example of how the new rules will apply in practice. As I say, there are obviously lots of other permutations that you can dream up and can come up with, but I did think it was, I hope, would be useful just to have a look at this early stage at some of the figure work that is going to come from the operation of these two new 5% economic tests in the Finance Act 2019. Thank you for listening to this talk. My name is Robert Jamieson.